What's happening, guys? In this video, we're gonna be talking about a risk management trading strategy. I like to call it scaling in on your trades or layer entries. This involves taking multiple entries on one position. A lot of traders like to go all in on one position and put their full entry at one entry price. I personally don't like to do that. I'm gonna show you guys something here in this video, a little tip that I like to do that helps me personally in my trading get a better risk to reward and better risk management overall. I don't go all in on my entire trading position. I like to trade gold. So let's say I'm trading gold today and I'm gonna trade gold with one standard lot. Let's just say one standard lot, for example, is what I'm gonna use today, and I'm gonna be trading gold with that position size. Typically, I'm not gonna enter my one standard lot at one entry price. I'm gonna try spreading that one standard lot out between different entry prices around a certain area or in a zone. Gold, which is something I like to trade, it's really volatile. So its candlesticks can have a lot of pip movements. It will move on average 20, 30 pips in one candlestick. So this is a strategy I like to use on gold, kind of spreading out my entries in one area. Let's say I'm using a one standard lot on a position on gold. So I'm gonna take a one standard lot position. Instead of putting that standard lot at one entry price, I'm gonna maybe put it at 2 or 3 or even 4 or 5 different entry prices. Let me explain. If I have one standard lot, that really gives me, if I look at it, 10.1s. Or I could say I have 5.2s. I don't have to look at it as I'm gonna enter a full standard lot at this price. I could spread it out with the other lot sizes. For instance, I could use 5.2s on this position. I could instead of one lot, I could separate that one lot and break it down into other positions like a 0.2 or a 0.1 at different entry prices. For instance, if we have a support zone and the market's coming down to a support zone, you could put your one lot right here at the first entry price. And that's gonna give you that entry price, and that's gonna give you one stop loss, right? I'm gonna put my stop loss here and I'm gonna have my entry price there. So that's it. Whereas scaling in your trades or layer entries, as I like to call it, just multiple entries on the same position, it gives us more entries and potentially more risk to reward. If I have a 0.1 here and then a 0.1 also down here, but I have the same stop loss for both entries, one of the entries now has a greater risk to reward than the other. Right now, I'm total 0.2 in on my trade, and it's at different entries. One of my entry points has a greater risk to reward than the other because it's a better entry point, it's lower. I'm looking for a buy here on the market, and I've bought in lower at my second entry price. So I've scaled in a better entry price. I'm keeping the same stop loss for both entries. That way, the second entry gives me a better risk to reward, or even my third and fourth entries. I can place multiple entries in my zone. What does this do? This allows me to give more time for the market. Instead of going all in the market at one time, I'm taking a little step back. I'm spreading my entries out and kind of testing the charts, testing the waters to see how the market's reacting. Giving more time for the market to move also, because chances are the minute I enter a trade, the market's not just gonna go straight into profit. Unless I'm really waiting, really patient, timing it right with the right strategy. But if I'm just everyday trading or scalping, the chances of me entering and the market going right into profit and hitting my target right away, it's not gonna happen all the time. There's usually what I like to call the drawdown phase. When I enter a trade, it's not gonna go right into profit. I understand that. I might go negative 10 pips, 20 pips, or even sometimes up to 30 pips because we're trading gold, and gold can move hundreds of pips. Or even when we're trading crypto as well, crypto can move lots and lots of pips as well, and even currency pairs. So I like to consider maybe even a drawdown phase. There could be a drawdown phase where I enter the market and the market goes against me a little bit. I take advantage of that because usually my analysis is correct when we're looking at the market going a certain direction. This strategy, we call it averaging our position. We're averaging an entry position. We can use this strategy also in crypto. In cryptocurrency, This is called the dollar cost averaging strategy. So let me explain this in crypto, and you guys will maybe have a better understanding of this also for the Forex side. The problem a lot of regular and everyday people make when they get into crypto, for instance, is they'll save some money, and they'll invest it at the wrong time. Or they'll invest it at the wrong part of the market or the wrong part of the crypto cycle. If you guys have watched any of my other previous videos on crypto, we've talked about crypto cycles. So go back and check out some of our crypto videos if you haven't seen them. Crypto, the average person gets into crypto extremely high. We already know the average retail trader is gonna be buying Bitcoin at 70, 80, 90, 100,000, right? Last cycle, most average people were buying Bitcoin on the way to 50, 60, 69,000 before it went into its bear market. So crypto has cycles. Crypto goes up, but it doesn't go up forever. Crypto goes down, but it doesn't go down forever. And then it also accumulates, and it doesn't accumulate forever. Understanding dollar cost average strategy is really key in crypto as well, because you don't want to be one of those people who lump sums an investment at the wrong time. It's better to be buying crypto when it's going down than when it's going up. I also think it's better to put a lump sum of money over time. So for instance, instead of buying a lump sum strategy is putting $20,000 in at one price. Whereas dollar cost averaging would be that $20,000, I'm spreading it out at different prices. $5,000 I bought at 40,000. Another 5,000 I bought at 30,000. Another 5,000 I bought at 20,000. So I'm spreading out a lump sum of cash at different prices. Problem, and a reason why a lot of people hate crypto is because they lump sum at the wrong time. 90% of people lump sum their savings into crypto or what they've been waiting to put into crypto at the end of the cycle. You want to be dollar cost averaging crypto because when it goes up, you will reap the benefit. Let me show you on the chart, for instance. Let's pull up the Bitcoin chart real quick, and we're going to go over to our crypto pairs here, and we're just going to look at Bitcoin real quick. And I'm going to explain what I was just talking about on the charts. So here we're on Bitcoin. And I'm gonna take off all our technical analysis and drawing on the chart because we have another video, Bitcoin update number 3. Make sure you guys watch it if you haven't seen it. So for instance, right here, this was last bull cycle. So bull cycle is when it's bullish and we're in an uptrend. Look it, most people were buying Bitcoin when it was up here. Most people were getting into Bitcoin around these levels, which for some time it went up. But think about where they were in the cycle and where their money stayed. Their money stayed up here as the bear market came in, right? So think about where that lump sum investment stayed for a lot of those people. Some people invest $10,000 up here, 10,000 up here, 10,000 up here, and it stayed there. And when the market reached bear cycle, there's nothing they could really do. They just watched that value depreciate. So I think it's better to be trying to dollar cost average when the market is in that decline, when you know people are freaking out, when there's panics. In stocks, in crypto, even in Forex, when people are freaking out, when there's panic, those are the best times to buy. We like to say when there's blood on the streets, those are the best times to buy. When the market's in a bear market, buy when most are fearful, sell when most are greedy. We want to buy in times of fear. This is where dollar cost average strategy in crypto plays a huge role. Picture the bear market here, because crypto has 3 phases: bear market, accumulation, bull market. So picture the bear market. This would have been the time to be dollar cost averaging. All through the time where everyone's panicking, everyone's freaking out. Right now is not the time to be dollar cost averaging as the market goes up. Right now is not that time. You would want a dollar cost average as this market comes back downwards more and maybe makes a correction as it's going down. A lump sum What's the best time to put a lump sum strategy? That's when we know the market has been dropping for a period of time and we know we're at lows and we know we've been in a bear market. The best time to do lump sum is when the market has fallen significantly over a period of time. Crypto will go through that. It's done it before. If we go back, so here, for instance, this is the bull cycle. This is the bear cycle. So the wrong time to be lump sum investing or even dollar cost averaging would have been all through here when the market's going up, right? Because the market's on an incline. At some point, your money is going to be up there unless you sell, right? Buy low, sell high. The best time for dollar cost averaging is when the market is on that decline. So guys, I hope this video was some help and some good tips on Forex and crypto dollar cost averaging strategies. Watch the Bitcoin update video. I just posted it. It's on the channel. We have a Bitcoin update video before the year ends. Our Bitcoin number 3 video. Make sure you check it out, guys. I'll see you there. But listen, guys, if you guys are interested in more of this information and more of this type of insight, I have a personal mentorship where I share a lot of these insights and a lot of this analysis every single day. So if you're interested, hit me up if you want to be a part of the community. Remember to like this video, guys, subscribe, and comment if there's anything you guys want to see on the next video.